Even in advance of the headlines this morning, we were already seeing hikes being priced in basically across the globe, the most immediate being the ECB this week. That isn't going to change because that was all predicated on inflation that we believed would already work through the system and secondary effects that may continue even if the straits were to open, I would say, end of July, mid-August. So the fact that there is more turmoil in the Middle East, the market is already ready for that in 2026. I think what's up for play is the duration of this could impact what happens in 2027.
And just thinking about those potential rate hikes, obviously we know the ECB likely this week. We've heard actually from the UK this morning, Bank of England policymaker Alan Taylor telling Sky News that he's comfortable with interest rates at their current level and that they're quite restrictive. Is it less of a foregone conclusion here in the UK? And how well equipped are we already, given perhaps rates are a bit higher in the UK, against inflation?
That's exactly right. The base rate in the UK is different than what the ECB is holding on to. I mean, percentage points different, in fact. So there is more flexibility to be more in a wait and see mode, where the ECB not only has telegraphed that they are going to go and therefore need to go for a credibility basis, but the ECB with a 2% handle, that's a very different set of situations than what the UK is facing.
Where do you see the risk of a mistake from central banks hiking at this moment? The picture obviously still relatively unclear as to what's going to happen with the Middle East and the effect on inflation there.
Yeah, I don't think it's a mistake because what's being priced in and I think what's being discussed really across the globe is a very metered approach. Now, I contrast that with what happened both on the last hiking cycle and the last cutting cycle, where we saw various central banks go more than just a one stair-step function. We had cuts, for example, the ECB went 60 at one point in time. The U.S. did massive cuts when there was concerns. That is not the situation that we're in right now. So I think 25 basis points is something everyone can be very comfortable with. And that slow, thoughtful approach, even if it starts earlier than some may like, is, I think, digestible by the markets, especially when it's coupled with forward guidance.
And we had that Friday payroll number out of the US, of course. I wonder how that's affected your outlook for the Fed. I can't help but notice that you're overweight in US credit, and you said this is because of a strong macro background. Do you think that's beginning to crack slightly, particularly with that perhaps test of that strong US jobs data? Does it worry you at all?
So it's definitely something to watch. In the U.S., there's a dual mandate with the labor market and price stability when it comes to how the Fed debates their next move. The labor market from that print, and really what's on the back of what we've seen for the last three prints, is a very strong labor market. Not one that's overheating, but one that's certainly tightening. That does mean that there is no likelihood that there will be cuts this year. We do believe, though, that the Fed will stay on hold, that they don't need to be aggressive and hike. We do think that there can be a world in which there are cuts next year. Those for us, though, on the back of that number, to your point, have been pushed later in the year. So how do you circle the square with liking U.S. credit? So U.S. credit, there are many things that go into it, one of which is also the macro backdrop, but the other piece of it is just the strength of these companies. And they have fortress balance sheets. And the U.S., while maybe not growing as fast as we anticipated at the beginning of the year, given the war, we still believe that the U.S. is going to grow at about 2%. That's trend. And then when you look underneath the hood of the car, when we say we like credit, we don't like all things. We find certain sectors are doing extremely well, are very strong, and that there's opportunities and a bit of dispersion where we can pick our points because we are, in fact, an active manager.
Are there areas where you would be concerned about credit at the moment when you're thinking across the US landscape?
Yeah, one of the things as rates are moving higher, and certainly they have this year, and especially further out the curve as there's this debate, and it's not just a U.S. thing, but it's across the board about fiscal policy. That affects the back end of the curve even more. Those are the places, the 5-year node, the 10-year node, the 30-year node. Those are often the base rates that corporations have to use when they think about pricing deals to raise money. The big thing, therefore, is thinking about who has financing needs now and who has it later. Right now, there isn't, been in the business for 20 years. A big thing we always worry about is there a cliff? Is there a wall of maturities, a need of refinancing now? That is not the case. That doesn't happen for a couple years. We find the duration in the credit markets, the average duration, to be a little bit over 5 years. That gives you enough time to figure out how you want to finance. And what's been interesting, and we saw this last week, we've seen a lot of companies not go to the debt market, actually, and instead pivot and go to the equity market. So that would mean net less issuance in credit, and that would be a positive technical.